Good Thursday afternoon to you. Welcome to the Jon Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you and a pleasure to be with my co-host. Glad I'm not having to fly solo today, boys. I'll just tell you, I'm tired, stressed out. Yeah, it's all the above. So I'm glad I'm with my buddies today to be able to share the well, both of us, Dwight, for once, both of us had bad news today. Oh my goodness, Dwight Millard of On Q Home Loans. How are you, my friend?
John, I'm doing okay, and I just love your attitude. I mean, you could be doom and gloom. No, but you come on here every day with a positive attitude, and that's what keeps the world going around. So
that's what keeps it going around. Absolutely.
Yeah, so,
Thank you, brother. Appreciate that
pleasure to
so
be
much. Here. Indeed it is. Thank you. Aaron Clark of Lady, how are you?
I'm doing great. Going to be a fun topic today.
Yeah, isn't that the truth? You're in the nice, calm, cool, collected world, Aaron. The world of housing, at least for the moment.
Yeah.
But we will.
My world's like a parasite. It hits you where you're not expecting it.
Yeah, exactly. And where there's one problem, there's many, many more.
Yeah, it's affecting the whole system.
It really is. Speaking of that, I use that analogy where there's one cockroach, there's, hundreds of others. And I use that, guys, gosh, what's it been now? Probably close to a month ago when I started to see, and not just me, but everybody on Wall Street started to see problems with these private credit funds, speaking of which. And I spent a few minutes on the show. I think it was on a Friday. Matter of fact, it was this last Friday, bringing everybody up to date. Dwight, there was a mortgage company in the UK that went belly up. They were borrowing money on assets from various lenders saying, oh, you're the only lender on this asset. So, but anyways, this is the other issue that, weighed on the market today, and it's just getting worse and worse. And these private credit funds. All of a sudden there's a bunch of redemptions, and this is what happens. The old cockroach theory, where there's one problem, there's many more. And so we've had a number of these private credit funds from some of the major Wall Street firms say, hey, you know what? You're limited to redemptions, which is very normal. It's in the prospectus of a lot of these different companies, but people forget that. And a lot of these funds are getting hit with redemptions, and the fund's like, no, we can't give you the money back. And so it just makes all the headlines, and the bottom line, it weighs on the market. And so you take that on top of the problem with the oil situation. And yeah, we had us a fine mess today, to say the very least.
What is it, John? Everybody wants their money back? Is that kind of that?
Yeah, that's what it is. We're getting into a situation, Dwight, where liquidity is really becoming a major issue. When you get into global tensions like this, and I'm talking on the institutional side more so on the retail than on the retail side, what ends up happening is these institutions they start to get real panicky, right? And so they're getting hit with redemptions from their clients, right? They want their money back, and so it creates this cascading effect where they start selling everything. And that's frankly, that's one of the reasons that we've not seen gold do anything spectacular during this Iraq war, because people are going, you know what? I've had a good run up in gold. Let's liquidate it. Let's get some cash going. So everyone's in the cash generation mode right now. And that's, again, what's happening on the private credit side of things, but also with a lot of different areas. It's happening, in your world. I mean, you're seeing a lot of bond redemptions going on because people need the cash. So they want to sit on the cash for whatever the reason is, whether it's panic or, they got bills to pay. Maybe they lost a bunch of money in the market from a margin standpoint or something. But the bottom line is liquidity is the name of the game right now. And if you can't provide it, you're getting spanked pretty good. And we're seeing some of these private credit funds just stock performance is just horrific.
Well, I'll see if I can research it and find it. I don't know if I'll get it, but one of the key indicators in my world is if you start selling your servicing portfolio, because that's how you get cash. So if people are experiencing one servicer to the next, it may just be an attempt to recapture some cash.
Absolutely.
Yeah.
Absolutely.
And there's billions of servicing portfolios out there. And that's the easiest way really to get cash right now.
Yes. No, that's an excellent point. You haven't mentioned that in a long time. I don't like when you mention that.
No, yeah. I don't know that it's happening. Back some
memories of 08, 09.
Yeah. I mean, you're seeing some pullback, some tightening on some guidelines, but it's not been anything that's been, alarming, let's just say. Right. But it'd be interesting to see if there is some liquidity issues and people are dumping their servicing portfolios a little bit.
Yes.
I'll have to look into that.
Yeah, please. Yeah, please monitor that side of it. All right, folks, let me tell you what we have lined up with Aaron and with Dwight. Today, besides everything in the market that, of course, I'll get to in just a second, today, Washington passed the biggest housing affordability bill in 30 years. And it includes a very, very controversial rule, a new rule. Of course, it's backed by the president. I think this originally was his idea. And what this rule that passed the Senate today says is the government can ban large investors from buying single family homes. We're talking if they already own 350 homes or more, this bill would ban them from buying any more. Now, remember, folks, after that 08-09 time period and the crunch and everything that happened, the institutional investors in many cases were the savior, right? Because they came in and they gobbled up a bunch of houses. But when I say the savior, it depends upon what side of the fence you're on. And this is what Aaron's going to really explain, because the supporters of this bill, and again, this only passed the Senate. They're not saying it's got much luck to go as far as the House is concerned. But what the supporters are saying is this is going to give families finally a chance to buy, right? It's going to free up some of the inventory that is out there. The critics actually say it could reduce the housing supply. It could drive rents higher. It could drive prices higher, so on and so forth. So we're going to break this down and see, okay, what kind of impact could this really have on your home's value, mortgage rates, the housing market, everything in general? Guys, it was a big deal when this bill passed today, and many didn't think that it was going to happen. Many thought that it was going to not get through the Senate or the House, and of course, it got through the Senate today. Pretty big good majority. Matter of fact, 89-10 was the vote, and so it's originally designed to increase single-family housing supply. That's why the president came up with this idea. They're going to give local governments incentives to allow more building. But the headline, again, it's going to restrict the large investor. And so what we're going to be talking about and kind of debating is, does this marketplace, this housing marketplace, does it need the large investor? These big institutions that are now publicly traded, worth billions and billions of dollars and that own thousands and thousands of homes, what happens if they're out of the marketplace? Yeah. So it's going to be a fascinating topic, right, Aaron?
Yeah. And what's interesting too is, this bill, I feel, really just addresses the symptom, which is the investors, not the problem.
Yeah.
Which is lack of inventory.
Yeah.
And that's kind of how I feel about it. The whole concept of it kind of bugs me, but
does it?
We'll get into it. Yeah.
Yeah. Yeah.
John, I think, to add to Aaron's point, my dear friend, your dear friend over at the Builders Association would tell you that they've been trying now for years to get land released from the federal government, and they can't, So, I mean, if you're, you know what I'm saying? I mean, I agree
that
with
would
Aaron.
Actually solve some issues right there.
That's what I'm saying. I agree with Aaron. This is Bactine. This is not a cure at all. The cure, right. I mean, we talked before this even came up, we talked about, hey, what about getting rid of the loan level price adjusters that Fannie and Freddie have added since 2008? All that billions and billions of dollars that get taken away from the consumer. So there are other ways. We'll get into it, but it'd be interesting to maybe sometime get Dan on here and shed some light about the building community just in Northern Nevada and what they've been fighting, I think, for 4 or 5 years now.
Oh, yeah, if not longer. Yeah. No, that's a good point, Dwight. All right. Well, a lot of things, obviously, in the housing world, a lot of things going on in the stock market. Let me get the bad news out of the way, and then I'm going to build up to what happened going into the close today. So it was a tough one right from the get-go. Pre-market, we were down 200 to 300 points, nearly 400 points. Matter of fact, right before the open, we were down almost 500 points. So it was going to be a rough one. What we didn't get today that we've received these last couple of days is kind of buy the dip mentality. These last few days, when we've dipped between 500 to 700 points, the buyer stepped in. They tried doing that again today, but the sellers absolutely dominated. Every time it was the whack-a-mole game. Once again, every time the stock started to rise, then here came the sellers, and they just pounded this thing down. I think now, guys, I'm starting to feel, and again, this is just from experience, I'm starting to feel two different things. Number one, I'm starting to feel fatigue, meaning investors are getting very fatigued with the oil and the war headlines. Then you throw the private credit headlines into there. Then you add in the other issue, which is what I said a couple of days ago on the show. And I said, I hate to say this, but here's the reality. We have not had one of these big, what we call a flush on Wall Street. And a flush is designed to scare all of you that are listening to us right now out of the market, right? This is where you have a very, very abrupt 1,000, 2,000, some crazy massive sell-off that lasts literally, in most cases, just a few hours or a few minutes sometimes, but it's enough to scare investors. They dump their stocks, institutions jump in, they buy the stocks, the market runs back up. And in most market corrections, you eventually, not always, but you eventually end up having one of these flushes. We have not had that. This has kind of been the splinter in the underneath the nail bed type of market conditions these last few weeks. It's just been painful. You start to pull the splinter out and your finger feels a little bit better, meaning the market goes up for a day and then the splinter goes right back in, market goes back down and you're in pain. That's what I'm starting to feel right now that we're seeing going on with investors. It's just a lot of pain at this point. They're selling a lot of things. Not everything is going down, But you look at this whole oil situation. You have the airlines just getting tanked. I mean, Southwest Air today down 7.75. You have the truckers, Old Dominion down $12.54, a little over 6.5% loss. Cruise lines down almost 8%. Tesla down 3%. I mean, the list goes on and on. And again, they kind of throw the baby out with the bathwater. They back to the liquidity issue that a lot of people are not really paying enough attention to. But that's why gold prices today down $53.40. Guys, in a day where the market did what it did, you should not see gold prices go down. If things were acting normal, you would see gold prices surge, but they're not. Let me tell you when we come back from the break what we did, give you some more of the reasons behind it, and then we're going to get into our topic today. The investor ban, is it going to fix the housing market or is it going to break it? The boys will let us know. Let's turn it over to Kristen Snow. She's in the Right Now Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Dwight Millard of On Q Home Loans and Aaron Clark of Edge Realty. All right, we're going to be getting into our topic again, big investor ban. That's what the government wants. They want the big boys, the publicly traded companies that came in and swooped up thousands and thousands of homes after the financial crisis that if you own more than 350 homes, you can't buy any more. Yeah, pass the Senate today. We're going to talk about the pros and the cons of this. And again, you'll find out they're saying not much likelihood it's going to pass the House, at least under its current version. All right, so let's get the news out of the way today. Like I said, it was a tough session going right from the pre-market all the way into the close. We finished down 739 points on the Dow, a 1.56% loss to a close of 46,677. The Nasdaq lost 404 points, 1.78%, closing at 23,111. And the S&P gave up 103 points, 1.52% to 6,672. And I want to throw the Russell 2000, the small caps in there. That was a 2.12% loss. So this is the analogy I was saying before we went to the break, where it's like you get a splinter in underneath your fingernail. It hurts, and then you pull it out and it still hurts, and then you get another one. That's the pain that investors are starting to feel. I'm starting to feel that investors are really starting to get into the investor fatigue mode, where they're trying to sit here and go, how much more is this going to happen? Because what we're seeing happen, guys, is a lot is, it's a 1% loss today. It's 1.25% tomorrow. So it's not that big flush that I was saying in the last segment, but it's 1%, 1.5%. And before you know it, you really find yourself in a situation where, geez, we're in a correction mode. We're down 10% very easily. Year to date, we're just, Yep, buy paper cut. Yeah, buy splinter.
Well, year to date, what's amazing, you say that it's we've been talking about this now probably for a couple of years now, is just the consumer is fatigued on everything, housing, on groceries. Everything. Now you got to add this to it. There's just so much. The bandwidth, most people just, it's hard for them to sort it out, to sort the nuts and bolts out of everything around them. So
you're right. You're absolutely right.
The less you can take off their plate, the easier it makes them to kind of find some decision points.
You bet. Here's what we said on a year-to-date basis. I usually say this to Friday, but let's bring it out. For the year, the Dow's down 2.9%. Nasdaq's lost 4%. S&P 500 negative 2.5%. And the Russell, which was up at our best level, we were up a little over 6%, if I remember right. Right now, we're up just 0.3%. So again, nothing significant at this point, but it starts to add up. Like I said, these losses over and over again. All right, let's hit the commodity side. Big, strong day for oil. 84-cent rise, $95.42. So let's bring you up to the date on the latest headlines. I told you yesterday that news services were reporting that a few tankers were being hit by drone shrapnel, causing some damage. Okay, we come into today. Evidently, more is starting to happen. We had the new Khomeini indicate that he wants to keep the strait closed, which again, all that means is he's threatening to do more damage to any ships going through there. Then we had the Secretary Chris Wright, who just the other day came out on X and said, oh yeah, we're going to start escorting vessels through the Strait of Hormuz. Well, he came out today and said, well, he ended up correcting himself. Remember, about an hour later, the White House corrected him, I should say. He said, yeah, we're going to start escorts. Market got excited. Oil prices went down. Then the White House came out about an hour later and said, no, don't know what the secretary is talking about. That's not the case. Now we fast forward to today. Chris Wright came out, told CNBC today that the U.S. Navy is not ready to escort tankers through the strait, though it aims to be able to do so by the end of the month. All right, guys. So there's the latest of what happened today. We're still reeling with, I know, Aaron, you got to laugh. We're still reeling with what happened yesterday. So yesterday, remember, as I discussed on the program, the International Energy Agency announced 400 million barrels of strategic petroleum reserves of the 32 countries around the world were going to be released. Okay, so they're going to open up the spigot. But I was critical of that yesterday. And I said, wait a minute here. We don't know who's doing what. In other words, how many barrels each country is doing. We didn't know what the U.S. was going to do. Well, until later in the evening. So 400 million barrels, largest ever in history, largest release from strategic petroleum reserves ever in history. Okay, so it's a monumental event. But again, devil's in the details. When's it going to start? What kind of oil is going to be released? I mean, all these different situations. Now, later in the day, the United States government came out and said, okay, here's what we're going to do. We're going to release 172 million barrels of the 400 million barrels. That's a significant sum.
Yeah.
Okay. But here's the downside. Again, devil in the details. It's going to take 120 days before they start releasing it. Guys, we're talking 4 months. Can you imagine 4 months? Now, let's use the United States. And again, this news came out after the show yesterday. Let's use the United States as an example. Okay. If it's going to take the U.S. 4 months, does that mean it's going to take everybody else for their, the 230 million barrels? Is it going to take them 4 months? I mean, where would oil prices be at that point? And this is what I said yesterday on the show. I said, look, this is great that they announced that. However, I did the math and I said, look, you've got 400 million barrels that these countries are going to release. We're losing 20 million barrels a day because the strait is essentially closed. Okay. 400 divided by 20 is 20. So that means we've got 20 days. If the oil was released today, the 400 million barrels released today,
20 days, 4 months from now.
There you go. That's
crazy.
Exactly right, Mr. Clark. So really, what difference does it make? But now if we use, hold one second, Dwight. Now if we use the U.S. as a proxy, again, saying it's going to take the U.S. 120 days before they can release anything, how long is it going to take these other countries, right? So once again, jawboning seems to be, I'm going to go back to my investor fatigue comment, jawboning has been saving this market, and I'm talking the oil side as well as the stock market side. It's been saving it for the last week or so, week and a half. I don't think what I saw today with oil prices rising, I think today was kind of the turning point where investors went, show me the money. The old Jerry Maguire line, show me the money. This time they're like, show me the oil. Show me the oil. Don't just tell me, show me the oil. And no country's doing it.
Well, I was just going to say, John, I mean, just even go down 30 days from now on what you were just saying. I mean, commerce is just going to stop. I mean,
it already started to. Yes.
I mean, what is it in California? You've got $7.83 a gallon in some places.
Yeah.
I mean, at some point in time, people are just going to say it's easier for me to stay home than. I mean, yeah. I don't.
It's going to be the oil lockdown.
Really. Yeah,
well, oil
like
lockdown. COVID, but oil.
Oil lockdown. Yeah.
Yeah.
Well, I got to add one quick point before we go to break. So I'm going to give you guys a little bit of naval knowledge. When I studied to get my Coast Guard captain's license, I had to study about this thing called the Jones Act. Well, I hadn't heard about it for a number of years since I studied for the test. Heard about it today. The Trump administration came out and said, we're proposing, I should say, to eliminate the Jones Act for 30 days. Now you may be going, what the heck's the Jones Act? This is an act, guys, that goes back to 1920, so it's over 100 years old. It was an act that was written after World War I. And what this act said, and this is national law, what the act says is, if you want to transport any goods from one U.S. port to another, you have to use a ship that is flagged in the U.S., it was built in the U.S., it is manned by a U.S. crew. So in other words, it's all U.S. Trump came out today and said, we're thinking about eliminating that for 30 days. What does that mean? That means every Tom, Dick, and Harry foreign vessel can come into our country and transport whatever the product is from one U.S. port to another. And the logic is, I found a study JP Morgan did back in 2022. And they said, and again, this was in 2022, they said by eliminating the Jones Act, and we've done it just a couple times in, I'll call it the last 20 years, it would have saved the consumer 10 cents a gallon because you're going from basically one East Coast port to another East Coast port. So that was another thing that the market went, big freaking deal.
Yeah.
Number one, we don't understand what the Jones Act is, but it's only for 30 days. You're just considering it. And really, is it going to make that big a difference in the price of oil? I don't know. But is that a scary thought, knowing that we can have Chinese vessels, we can have any vessel flagged anywhere from around the world come into our ports? The U.S. shipbuilders, guys, the U.S. port right now, they are furious at this. They are furious. Because I'll tell you, knowing mariner law, this is a prize act that no one wanted to give up. I was honestly very shocked that the president came up with that idea today. So we'll see, but that's the latest, kind of dangling the carrot out there that they're working on something. So thank goodness that they're doing that, but I still don't see anything that's really going to calm these oil prices down. I really don't. All right, let's turn it over to Jackson. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Dwight Millard of OnQ Home Loans and Aaron Clark of Edge Realty. All right, once again, we finished down 740 on the Dow, 1.56% loss. NASDAQ gave up 404, 1.78%. S&P lower by 1.5%, and the Russell 2000 declining 2.12%. Another strong day for oil. Overnight, I failed to mention this. Overnight, we did touch a bit over $100 a barrel, which we hadn't been at in quite a few days. We closed at $95.42, up $8.84, 40-cent loss on gold to 5,126. 7 basis point increase on the 10-year at a yield of 4.27. Dwight, how do we do on the 30-year mortgage? Or dare I ask?
No, don't ask. But let me put it in perspective, John. I don't like words like spike in the commentary, right? Rates spike. But anyhow, we were a week and a half ago, John, we were bragging about 5.99. We broke that 6. Today, you're up 11 basis points, which is big in one day. Two price changes for the worse. 6.35 on the 10-year. Matter of fact, John, your 15 now is at 5.95. You're only 5 basis points away from the 15-year going back over 6. So
isn't that something?
It's been in the 5s for so long. So it's just, as you've said, as oil goes, so do the rates.
Yep.
So,
well, and again, we got to watch this liquidity squeeze, guys. If this private credit situation, as we discussed in the first segment, if the private credit situation worsens and liquidity continues to squeeze investors, you're going to see them continuing to sell bonds. And that, of course, has an inverse effect to the yields. Yields go up. The bond price comes down as the selling pressure exacerbates. So, yeah, Dwight, you got a lot of forces against you right now, kind of like the stock market. So, yeah, misery loves company, my friend. Misery loves company. All right, let's get down to our day's topic again. We had a very interesting situation unfold out of Washington today. And I think this was a shock to a lot of people. So the Senate passed the biggest housing affordability bill that we have ever seen. Well, let me rephrase that. 30 years is what they're saying, but this is called since we've ever seen it. It's got a brand new controversial new rule. Remember, this idea was floated by the president. And what this is, you're going to find out, could ban large investors from buying single family homes. So we got this argument going on. Now, I just want to be real clear with everybody. This passed the Senate. They're saying this version is not going to pass the House. The House has its own version. So as usual, if this thing doesn't die, then they'll come together and take a little bit of the House's side, a little bit of the Senate side, and go for there. But bottom line is, let's start to discuss what happened. So, as I said earlier, it was a big victory, 89-10. It was the vote. So, what this is designed to do, as I said, it's going to increase single-family housing supply. It's going to give local governments incentives to allow more building, but it's going to restrict large builders. Now, remember, we have a number of large builders out there: Invitation Homes, American Homes for Rent, Tricon Residential, Blue Rock Home Trust. Those are just a couple names that a lot of people know about. Those are publicly traded companies that, again, went out, they gobbled up thousands and thousands of homes when the housing crisis happened in 08 and 09, and then bundled them together, created a publicly traded company, which, Dwight, do you remember Corey and I predicted that exact same thing was going to happen? Remember when Corey would share his stories? I'm sure you heard him too, Aaron, where he was getting calls. You were probably getting calls from big institutional investors saying, hey, we want to buy, whatever, 100, 200, 300, 500 homes, whatever it was. And Corey and I both said they're going to bundle them up. They get it big enough. They're going to bundle them off. They're going to sell them off to Wall Street. And sure enough, they did exactly that. So what we're going to discuss now is, could this make the housing market worse from a supply and demand standpoint, et cetera? So, Aaron, let's kind of let's get the negatives, right? So we're going to show you some negatives and show you some positives here. Let's talk about, could this kill the build to rent housing?
I mean, I think you totally have that potential situation, because if these institutional investors can't come in and focus on housing purchases, which they've been doing, which, remember, the return on investment for them is the funding for increasing building projects and things like that, which would include those rental housing markets. And we see them all over town popping up, kind of a new thing, but they're gaining traction fast.
Yeah, stop right there. I'm glad you brought that up. So a lot of people are not aware of that. So there are housing tracts being built, not to be sold, but to be rented by some very, very large national developers.
Correct. It's like an apartment complex, but instead of them being condo style units with shared walls, They're individual homes within a community. Some of them will have clubhouses and things like that, just like an apartment, but you still get that vibe and feel of a single family residence. So remember that, like I was saying earlier, that it addresses the symptom, which is the investors, but not the problem, which is the lack of supply. So if you steal the investors' potential of coming in and dumping money into the market of housing, then what's their incentive to continue to grow the housing side on anything, whether
well as we're going to but as we're going to discuss, the counter argument is now it's going to open up the housing market for the retail, let's use it since we're talking investors, the retail investor, right? The guy or gal that wants to go buy that first family rental, maybe a small duplex, whatever the case is, and get into the housing game. Now they're going to go, hey, we're not competing against the big boys of Wall Street. We can come in and start to do that now. So,
well, and I think that's the surface assumption
yes,
that we will see. Because I think instantaneously, if this were all to come together in first year or two, we might go, oh, it's working. But as time goes by and those institutional investors are dumping inventory and things like that, and they're pulling out of housing projects and markets, we're going to go back to the original issue, which is going to be worse, which is the lack of supply. You want to fix the problem, you've got to start at the heart of the problem, which is supply. ADUs, multifamily, all that stuff, you have to increase that.
The argument, of course, again, those that are against this saying, wait a minute, it's going to reduce rental availability. We know we have a rental challenge in a lot of states around the country. And most importantly, it's going to put rents higher. As you said, Dwight, at the beginning of the show, I'll give you full credit. The consumer is stretched, right? You tell them, because now the inventory problem is going to get even worse. Now rents are going to go higher. Landlords are going to love it, right, Aaron? I mean, this is really going to make it look good to be a landlord.
They're already salivating.
That's right.
Yeah.
That's right.
John, there was nothing, in my opinion, there was nothing proactive in this. Nothing about acquiring land, giving land, selling land to the states, beating on the, local municipalities and counties, to keep their hookup fees and all that. All this it's defensive. I mean, right? It's reactive.
I'm glad you said that, because here's my opinion of the bill. And again, this is just the Senate bill. This is a pacifier for the public. This to me is a prime example of politicians saying, let's use my term, let's jawbone. Let's let the public think that we're doing something great. We're looking out for them. We're going to open up inventory. But as we all know, a lot of politicians don't think very clearly, or they think with their donation checkbook. And in reality, I mean, you two are both experts in this area. It's not going to help. Right, Aaron? It's going to make the problems worse, right?
No, and if you were to actually poll the public and you say, hey, how many homes, what percentage do you think of homes are owned by institutional investors that own 350 plus? You're going to get an overwhelming response that's going to be 15, 20, 30, 50. They're going to have these
what's the real number, Dwight?
Numbers.
Yeah,
and so from that idea,
yeah,
you're going to think it's going to create a huge, massive change in the market, when in reality it's like 3 to 4%. That's it.
Yeah. Dwight, how many houses are owned by institutional?
574,000 homes nationwide are owned by institutional investors.
And what is that? 3-4%? If I remember.
Yeah.
There you go.
So we're attacking the 3 to 4% problem.
We're attacking these companies. And again, it's spitting in the wind in the big scheme of things. 3 to 4% of homes that are out there, they're not I love what you said, Aaron. I'm going to repeat you. They're not the problem. The problem is lack of inventory. The problem is they should be spending this time to figure out ways to, again, free up some of the federal land that is out there that there's a bunch of empty sagebrush.
Permitting processes.
Yeah.
Exactly. Loan incentives. I mean, there's a million things they can
John,
do.
it's like eating 25 cookies a night, and I'm going to give up one.
You're right. Yeah. There you go. Good analogy. Let's wrap it up. Now I'm hungry. I'm going to wrap it up with Kristen Snow, the Right Now Traffic Center. Kristen, welcome back to the Jon Sanchez Show on News Talk 780 KOH with Aaron Clark of Edge Realty. Your phone number, sir.
6.
Dwight Millard of On-Q Home Loans. Your phone number, sir.
Yes, sir.
Thank you, fellas. All right. We're discussing this bill that passed the Senate today that wants to basically ban any of these large institutional home builders, investors, et cetera, from owning more than 350 homes. I want to clarify one thing before we run out of time. If you go and read the bill, there's here's the gist of it. If you're, again, one of these large institutional investors, you own 350 or more single family homes, you're done. Okay. You can't do that. They don't want you to own more than 350. But companies that add to the housing supply through building or serious renovations would be able to own more homes than the 350. But would need to sell those homes after no more than 7 years. So there's a little caveat there. Okay, boys, Now, again, this passed the Senate. They're saying that the House version is completely different, that this current Senate bill will not go through the House. We'll see what happens. I don't even know when the House is going to vote on this. I imagine, probably fairly soon if the Senate just voted on this. Aaron, let's come back to you as the realtor of the group. What's your advice? Let's look at two scenarios. Let's look at the scenario that this thing passes. Let's say the House version is very similar to this one, right? You're capped at 350 homes. Look in your crystal ball. Where are we looking at as far as home prices increasing, decreasing, rents going up, rents going down?
I mean, I think you're going to see increase in home pricing, and I think you'd see increase in rental pricing if
both bad
they
for the
are
consumer.
Prevented. Yeah,
then why in the hell would the government want to pass a bill that's bad for the consumer?
Because it's perception is reality, and to people that don't understand what this means, it sounds amazing on the surface. It sounds awesome.
Unless they listen to this show. That's exactly right. And Dwight, go back to your point for those that may have just joined us for this last segment. How many homes in America are owned by institutional investors?
Nationwide, which is 3 to 4%.
Yeah. So drop in the bucket.
Yeah, so and John, if those home prices go up, we already know the mortgage demand is going to go way down.
Yes.
Now we got a whole other problem. What are you
now we got a whole other mess.
Yeah.
They're
going to make them rebuy the houses again they were trying to get rid of.
Politicians for creating another mess. Thank you, politicians, if this thing goes. We're not going to get too excited about it. We wanted to bring it to you. As Dwight said, this is broke today. So we jumped on this story for you because, again, so many of you do own real estate, whether it's obviously your primary or the rental side of things. Aaron, what's kind of your final advice for someone right now? I'm going to take the words out of your mouth. I think you're going to say wait and see, right? Because obviously we don't know what the
as
house
far
side
as the bill
of
goes. Wait and see. Again, if you're doing something, if it's within the budget, none of this stuff should impact your decision. Keep moving forward. If not, and you feel uncomfortable, then wait. There's nothing that hurts you either way.
Yeah, beautiful. Dwight, how about you?
Yeah, I agree. I think, we'll figure it out if it gets to that point. But I wouldn't change my plans because this has been introduced and so many people supported it up for re-election, I'm sure.
Yeah. No, that's a very, very good point. Well, we will see what happens with it. We'll keep you updated the more that we hear. I do want to throw this in very quickly. Tomorrow is a really important day from an economic standpoint. We have the Fed's favorite measure of inflation, which is the PCE prices. We have those come out tomorrow. We've got the second read of the GDP number for the fourth quarter of last year. There, we'll see if we get another revision. Remember, you get 3 reports. This is going to be the second one, so we'll see exactly what that number shows. But this PCE number is a very important one. And then we've got University of Michigan consumer sentiment numbers, the preliminary report. This is that survey of consumers, and it's for the month of March. So I'm very interested to see what the consumers feeling about everything that's been going on. So real important day tomorrow. Going to be busy. Don't miss the show tomorrow night. Thanks, boys. You did a phenomenal job as always. And thank all of you for listening. We'll see you tomorrow on the Jon Sanchez Show. God bless.
Jon Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Dwight Millard, NMLS ID number 241259, a licensed mortgage loan officer with Highlands Residential Mortgage Limited and Equal Housing Lender. NMLS ID number 134871. The information shared on this live broadcast is for general information purposes only and does not constitute financial or mortgage advice. Listeners should consult directly with a licensed mortgage professional for guidance tailored to their specific situation. All loans are subject to credit approval and program guidelines. Not all applicants will qualify. Loan terms and availability may vary by state and are subject to change without notice. Highlands Residential Mortgage Limited is licensed in multiple states. For a full list of state licenses and disclosures, please visit https://www.highlandsmortgage.com/licenses/. The views expressed during this program are their own and do not necessarily reflect those of Highlands Residential Mortgage Limited.